All right, I'm ready to get started here. Looks like we have quite a few people in attendance, a few familiar faces as well. So great to have you guys out. Just as a heads up, once again, Kyle does have a bit of a concussion that he got last week. So he asked me to cover for him and help with this webinar on buying properties 5 through 10. As a heads up again, we are recording the video, putting it on YouTube for you guys to all rewatch and take some notes here. So it is 7:05, so I will get started here. Just going to start the presentation. And excuse me if there's any technology issues. I don't Zoom very often, so we're on test pilot here. Okay, so blueprint for purchasing 5+ properties. So our last webinar was on buying properties 1 through 5. Welcome, everyone. Table of contents for today. So the items we'll be discussing today are, we're going to do an overview of the first 5 and some important notes about buying the first 5 properties on the residential side. We're then going to talk about planning and some important key points around the planning area. Next, we'll cover the 3 core professionals, 3 very important people to have in your back pocket as you start scaling a portfolio of residential properties, whether to incorporate or not. So that's a big area that a lot of questions pop up, especially with some of our current clients. Personal finances, how to optimize your personal finances to continue borrowing and not get stuck. How lenders qualify rentals. It is important for you to understand how lenders look at rental properties as well as yourself to continue scaling. We'll go over 4 of the most common challenges that we see when clients are trying to get properties 5+, and then 3 solutions when those challenges arise and how we try to resolve them. After that, we'll talk briefly about the upcoming webinars, a Q&A in case you guys have any questions or any closing comments. So the last webinar, as I mentioned, was for buying properties 1 through 5. Kyle did speak on that about a month ago, and it should be up on YouTube. If you would like the link to that, let me know, and I'm happy to send that over. He detailed a lot of the important pieces that you need to know regarding getting your first property, second, and all the way through 5. And today we're going to be talking about 5+, which is a bit of a different ballgame. There's a lot of important rules that you should be aware of and kind of understand to be able to strategize to get a larger number of units. So the summary here, the first step is planning. Kyle did not make this quote, but he says it all the time. If you plan to fail, you fail. If you fail to plan, you plan to fail. Planning is very important. Speaking from experience of working with real estate investors, what I commonly see with new clients is getting into rental properties, buying the first few properties, and not having a full plan on how to continue scaling. What happens is typically people start getting stuck. It's important in the first 5, but it's even more important at 5+, as now we're starting to look at you as a business and you're starting to scale a rental business as opposed to just investing. Second piece is a HELOC on a residence. So if you own your residence, this is something that Kyle's done another webinar on. You should aim to be able to pull the equity out in a HELOC. It gives you more access to capital and liquidity. It is slightly higher rates, obviously, than a mortgage, but it's still cheaper than other forms of debt and equity. And lastly, structuring income properly. So if you are self-employed, it is really crucial to make sure that you're structuring how your income is reported. And not just when you're self-employed, but also your rental properties. If you have a certain number of properties, it starts to change the structure from a tax perspective. You have holdco, it changes it as well. And especially if you're doing short-term rental properties, the way that you claim it can make a big difference on continuing to scale your portfolio. So in the previous webinar, Kyle discussed if you're looking to buy 5 properties worth $500,000 and $2,500 a month, you're no longer able to use 5% down res. So that's for your residence only owner occupied property. Rental properties do require 20% down or potentially more depending on the lender and the situation. In general, the high level is you typically need about $150,000 to $220,000 of household income to continue scaling your portfolio. It's not absolutely necessary. I have seen certain clients be able to get higher than that, but it does get quite challenging because of the amount of debt that you have to service to continue building your portfolio. So some key points for properties 4 and 5. Again, we're kind of reviewing a little bit of the end piece of Kyle's webinar the last time of properties 1 through 5. Lenders guidelines vary and stack with more properties. So every lender has different guidelines and different policies for the number of properties that they have, that you have, and the number of mortgages that you have as well. And so when we're trying to get to 4 and 5, we are trying to understand how we can stack the guidelines in your favor to continue building your portfolio. DCR starts to become more relevant in some cases, especially if you're looking for lower rate options. Typically, the lowest rate options on market for when you get to properties 4, 5, and above start to use what's called a DCR, or debt coverage ratio, which is a bit of a different guideline, and it errs more on the side of commercial financing. Liquid assets are put under a larger magnifying glass. This is important even as an investor, not just from a lending side, but you should look to have a little bit more liquid assets to help cover any expenses that could pop up. And the lenders look at it as well. So if you don't have liquid assets, getting past property 4, 5, and above does become more and more challenging. And lastly, I guess this is kind of similar to the first point with the lender guidelines. Lenders do typically have a 5 max rule. Usually on the residential side, it's not 5 units, it's typically 5 titles. So it's a little bit of a nuance. So if you have a duplex that's on two titles, that would be classified as 2 separate properties. But if you have a duplex that's on 1 title, then that would actually be considered 1 property. So today we're going to be talking about 5+, and we're going to be diving a little bit into commercial financing as well, because this is where we start seeing commercial financing come into play, as well as a smaller, lesser known lender type called small business. First, we're going to start talking about planning. So purchasing the 5 to 10 properties, as mentioned, does require a lot more planning than buying the first 5. You first want to define your goals. Goals are very important, obviously, when you're scaling up any sort of business, but having different goals in real estate can make a huge difference when you're getting financing as well. Understanding how many properties is going to be an important piece. What type of properties and assets? So are we looking at residential specifically? Are we looking at mixed use, multifamily, industrial? As you start scaling up the property portfolio, understanding the asset class is going to be important for the type of financing. Cash flow is going to be an important piece as well. The higher the cash flow, the easier financing becomes for pretty much any type of financing in the space. So if you're looking for capital appreciation type plays, typically the cash flow is a lot lower, and financing those types of properties can become challenging. Goals for retirement and timelines as well. So a lot of people will get into real estate for a retirement plan. So understanding the timeline to be able to get to your goals is going to be an important piece as well here. From the goals, you do want to speak to professionals. We will talk about that in a bit, but talking to an accountant and a lawyer is going to be absolutely crucial, as well as a mortgage broker in trying to finance these types of portfolios and build up your portfolio to meet your goals. Taxes play a huge role in what you get to take home, because it's not about what you make, it's about what you keep. So your accountant's going to be an absolutely crucial person in the role. Lawyers are going to be important for various reasons like liability and contracts. And then obviously the mortgage broker is going to help with financing, trying to determine what kind of lending is going to be available to you, as well as raising capital and talking about equity and debt. And lastly is initiating the plan. Real estate and business is about action. And so taking action is important. So once you've created your goal, you don't want too much analysis paralysis. You are going to want to make sure that you take action and move forward. So again, here's the core planning professionals when it comes to financing these properties or these portfolios. There are other professionals that you should talk to as well, but we're going to go over the core 3 when it comes to trying to scale up from financing end. The first one is a lawyer. Your lawyer is going to be very important from a liability protection perspective. You want to be protected. You want to understand what your liabilities are when you're building a portfolio. If a tenant gets injured, for example, and you're renting out, you could be liable, and being able to structure your corporate structure as well as insurance is going to be an important piece. Corporate structuring is important for various reasons outside of just liability protection. It can help with financing when you're trying to scale larger. It can also help with tax planning and making sure you're tax efficient. Estate planning is going to be key too. If you're planning on passing down your portfolio or have any sort of wealth planning, the lawyer is going to help immensely with that section as well. And one that's not on this webinar here that could be also a huge importance is different types of creative financing. So sometimes when you're building a portfolio of real estate, you will look to use certain parts of creative financing, such as seller financing, vendor take-back mortgages, rent-to-owns or RTOs, and other things like that. The other professional that you should be aware of is the accountant. In my opinion, they're probably the most important person in the entire space for your planning professionals. They're going to plan around the taxes. One of the main reasons people get into real estate is for tax purposes. They're very tax efficient relative to other asset classes, as well as just discussing like your income, how you report your income and everything in between. The income planning is going to be a crucial piece. And usually what we end up doing is talking with the accountant on your behalf to make sure that we're claiming the right amount of income to get the best financing. Typically what happens is the accountant is trying to reduce your taxable income and have you pay as little taxes as possible, where lenders typically want the opposite. They want you to claim as much income as possible. And so it's a bit of a balancing act, and we need to understand your plan and talk to the accountant to understand how much income you should claim. The accountant will also talk about estate planning, similar to the lawyer. And lastly, the mortgage broker, of course, trying to understand how these financing products, these mortgage products fit together with your plan, where the capital is coming from and how the capital is looked at from the lender perspective. Understanding the qualification is going to be important. Every lender has different qualifications. And so you don't want to just go out and start borrowing from every single lender because the order of the lender is going to be important, which we will talk about later. Income planning, as we just talked about with the accountant, and proper lender selection, which we just talked about as well. So this is the big question. This one is the one that comes up pretty much every time I have a new client, and even our returning clients are asking this on a regular basis. Do you incorporate or you buy in personal name? We will talk also about holdco and opco because they do differ, as well as tiered corporate structures. All of these things are very important when you're planning the stuff out because they do affect the financing and what type of terms that you're going to have available. Kyle put in a math chart, so obligatory math thing. Personal name, holdco, or operating corporation. So this is what gets registered on title, and it's the actual owner of the property. So in some cases, you want to put in your personal name. So you personally want to have your name registered on the real estate title. Hold companies, depending who you talk to, the holding company could be different things. What we're talking about specifically is a corporation that holds real estate assets for passive income. So if you talk to some accountants, a holdco is a little bit of a different thing, but that's what we're going to be talking about, is one that specifically holds real estate. An operating corporation, in this case, is something that has operating income. So technically a business, sometimes the property management business or short-term rental income business might be considered operating company. And some of the differences between them. So with personal name, it's the easiest to get financing and probably the best rates and fees and everything that are involved. So personal financing, this is residential mortgages typically. So the classic banks, credit unions, and monolines. So when you see the cream of the crop rates online, it's usually when people are buying in personal name. It's easier to get financing as well. The qualifications are quite straightforward because we're not opening up a whole bunch of corporation documents and financial statements and all that stuff. So the numbers typically are easier and the guidelines are easier as well. Tax rate is typically between 20 to 50%. In Canada, it's approximately a 41% average tax rate. So that brings us to the holdco. Holdcos are a little bit different. Again, we're talking about holdcos that hold real estate passively. They're fairly difficult, but there are quite a few lenders, even on the residential side, that will do holding corporations. So this is what some people will use to scale their portfolio. Guidelines are typically similar to residential, so they will use your personal name as well as the real estate, the personal income as well as the real estate income when qualifying in most cases on residential. But small business and commercial will also obviously go into holdco as well. Tax rate is a bit higher. So Canada does tax a higher amount for passive income in holdcos at 50.7%. Operating corporation is the last one. It's next to impossible in residential to actually finance these inside an operating corporation. There's currently one lender in residential land that will actually finance inside of an operating corporation. Almost every other lender will not do an operating corporation. Primary reason actually has to do with liability. So what happens is if you have a bunch of income and you have employees and stuff like that, there's a liability where if someone gets injured and tries to sue, they could come after the real estate assets in the operating corporation. And so in most cases, you do want to silo off the real estate outside of the holdco anyway, even on your end. But the lenders also just don't like to finance them because it takes on too much risk and too much liability. Unfortunately, though, the tax rate is significantly better for operating corporations at about 10.5 and 15%. And so trying to put in the operating corporation does come up quite a bit because of a tax perspective. Okay, and so this is one of the more common ways that we find people come in holding or planning to hold real estate. A lot of tax accountants will advise this. The holdco part sometimes has a bit of nuance, but the structure typically is there's an individual at the top. They're going to be the owners of the entire thing. They own a real estate corporation, holdco, and then they have a real estate consulting management corporation. And on the other side, they have a cash holdco and then the operating corporation. The reason that they would build this way is for the flow of funds and to keep cash inside of corporations as opposed to taking it personally and paying personal taxes. So the longer you can keep your taxes inside the corporations, the more you can build your capital and continue compounding the returns. Eventually, you typically do pay some sort of taxes when you take the funds out of the corporations, but that's more of a tax accountant and estate planning question that I'm going to leave off for the time being. I'm just skipping through these arrows because, to be honest, I don't fully understand what was going on with the arrows here, but it's supposed to show like the flow of funds. So if you have an operating corporation, typically what we see is people moving money from the operating corporation. So if you have active income, they would move the cash from there into the cash holdco, and then they would either pay themselves individually for their salary or dividends, or they might move the cash into the real estate holdco in the form for down payment for future purposes or for other expenses. Simultaneously, the real estate consulting management corporation on the other side may take cash from the real estate co and charge the real estate co dividend or something similar, or some sort of consulting fee. There's different structures that can be made, and it's a bit more of a tax accountant question. I'm personally not licensed as a CPA, so it would be good to talk to an accountant about how to structure these. Sorry, I'm actually going to stay here for a second. So these are the common ones. So like I was mentioning before, in residential financing, these things are really difficult to try to finance. There's a lot of pros and cons to doing it this way, but if you're looking for the best financing, it's a little bit tricky to do. Few ways to move around it. Usually people will just have the holdco and buy real estate in the holdco and then set up the other corporations at a later date. So there's a lot of advising and again, planning. I really want to emphasize that planning is super crucial when we're building these portfolios. I don't really know why John Travolta was there, but we're going to skip that slide. So some of the positives for corporations is if you already own an operating corporation, it can be very beneficial to be continuing to purchase your real estate in a holdco. And the main reason is that you wouldn't have to claim all of that income personally. You wouldn't have to take the income personally outside of the corporation, pay the personal income tax, and then put it back into the real estate. You could take the income that's from the operating corporation, move it directly to the holdco as down payment, pay a smaller tax rate, and use that for buying real estate. So it's one of the more tax efficient ways. Yeah, Travolta was confused. It's one of the more tax efficient ways to move money around if you already have an operating corporation. The other main reason is going large scale. So if you're looking to scale a portfolio, it's a good idea to start considering, for many different reasons, putting your properties inside a holding corporation. And saying that if you're not going to be scaling, generally it's economies of scale. So having a small portfolio in a holdco usually is more expensive than what it's worth, with higher fees, tax planning fees, as well as higher rates. But if you're going to scale, it makes a huge difference and you do get economies of scale. Can be easier to get financing later down the road. It can also be easier for estate planning and disposing of properties as well. So for example, if you have a block of properties inside of a holding corporation, you can actually sell the entire block by selling shares of the corporation, as opposed to selling the individual properties, which can be really useful. The last part is estate planning. I personally don't do too much estate planning myself, but I believe Kyle does, and we do have some accountants that do a lot of estate planning, but having them in corporation can make moving the properties over to other people a lot easier, similar to the share sales. The downsides, as I was mentioning, the costs are a lot more expensive. You will be paying a certain amount per company. So especially if you're building a big portfolio and have multiple holding codes, multiple operating codes, there will be higher fees involved on the corporate level, as well as from a tax and legal planning side. As mentioned, harder and more expensive to get financing. So in most cases, holdcos will have some sort of premium included. So if you're getting a certain rate, there may be a premium to putting a property inside of a corporation, as well as sometimes fees depending on the lender. So with small business and commercial lending, what's different with them compared to residential is most of them will require some sort of lender or broker fee, like an origination fee. And then, as mentioned earlier too, residential lenders do not lend to multi-tiered corporate structures. The long story short is, again, it comes really down to risk and liability. Lenders typically don't like to follow the trail of beneficial owners because it gets a little bit confusing. I did have a conversation with one lender, and one of the reasons why is if you have a holdco and you sell that holdco with real estate to another person, the liability and the ownership of the asset gets really confusing, because if you keep the mortgages on it, you are still liable for the mortgages on the properties, but now the asset and the income is owned by somebody else. So it can make it very confusing for the lenders on the liability side. So next piece of planning, personal financing, making sure you can qualify. This is a really key piece. It's usually what we start talking about on first calls with our clients, just to make sure their personal side is optimized for financing. Obligatory graph with some real estate here. Don't know what this presentation slide was, but we're going to skip it. So how do you qualify? So before I get into these pieces, I will talk briefly about the high level formulas that lenders look at for qualifying. What typical residential lenders use is what's called a GDS or a TDS. It's gross debt servicing ratio or total debt servicing ratio. They're both roughly about the same for the purpose of this conversation. Basically what it is they take the expenses of the portfolio and yourself, divide it by the income of the portfolio and yourself. And that number typically needs to be below 44%. Some lenders have other guidelines, but we'll use 44%. The important thing to take note of is if we flip around that formula, what it really states is that only 44% of your income actually goes towards paying debt or expenses. So now that we have that cleared up, I will get into the actual slides here. 50% add to income. So there's two methods on the residential side for qualifying rental income specifically. We have what's called add to income and offsets. So add to income is where we're going to start. 50% add to income is very common for most subject properties. And what we mean by subject properties is the property that you're buying or refinancing. So when we're looking at that, what the lenders look at is not necessarily all of the rental income, and they don't necessarily look at it the strongest way either. What they'll do is, let's say, for example, you have a property with $1,000 of rental income. They'll do $500 added to income because that's 50% of the $1,000. It says 40% of income used. It's typically closer to 44%, but we'll use 40% for easier numbers. So again, 40% of your income can go towards paying debt. So 50% of 40% of $1,000 ends up being $200 that actually gets used for expense payments. So even though your rental property has $1,000 a month in rental income, it's actually only qualifying for $200 of expenses and mortgage debt. And then it brings us to offsets. So some lenders will use offsets. They're a little bit different. What they do is they take a portion of the rental income and directly apply it to the mortgage payments. So if you're doing an 80% offset, for example, you're taking 80% of the rental income, aka $800, and you're applying it directly to the mortgage that's on that property. So we don't have to water it down with the 40% of income goes towards debt. It just goes directly to it. What's been happening in the industry as of lately is OSFI. They're the regulators that oversee all of the lenders. They've been strapping down on the lenders and reducing the availability of these offset methods and policies, especially on subject properties. And so what's typical now is the stronger lenders will have an offset that's allowed on your non-subject properties, aka the properties you already own, but they may not allow you to use an offset on the subject properties. And basically what this has done is it's reduced the borrowing capacity over time. The offset is significantly stronger, as you can see with the amount of payment that it actually offsets. And the last important one is called DCR, or debt coverage ratio. This is where we start getting into portfolio lending and commercial guidelines. What it is, it's really simple. It's the complete reverse of the GDS TDS. It is instead income divided by expenses. And what it's asking is that your income divided by expenses is greater than 1.1 or 1.2. So basically you need to have 10% more income or 20 to 20% more income than the expenses on the property. What's important is they typically don't take in personal income into these calculations. And so it's usually property based, which can be a benefit or a negative depending on the situation. All of the income is added as a surplus, and the calculation is just a little bit different than what it would be for residential GDS TDS calculations. So some of the items that can be challenging as we build large portfolios, we see these types of things quite often. As you get over 5 rental properties, it just becomes more challenging due to lender guidelines. There's a lot of maximums for number of properties and number of mortgages we discussed before. The other piece is professional landlords. This comes up all the time. In general, every real estate investor that I've talked to eventually wants to rely entirely on their real estate income. Which sounds great on paper, but for qualifying for rental properties, it becomes really challenging because lenders typically need a base income that's not real estate. The reason is that real estate actually goes into a different category of income during the qualification process, and your standard income and employment income and self-employment income goes into a different section. So most lenders will want to see some sort of base income outside of real estate. For larger portfolios as well, they usually want to see liquid assets. On top of that, we did discuss that earlier. Liquid assets are very crucial. The way that the lenders look at it is if your tenants stop paying or they move out or whatever the case is for a substantial period of time, do you have the liquid capital to weather the storm? So it is important to think about, not just for lending, but also for you as a real estate investor. Low income. So this is kind of similar to the professional landlord, but it gets a little bit more nuanced with the stress test. So with the stress test implemented, the regulators wanted to make sure that you have enough cash flow on properties to be able to cover excess amount of interest rate or excess amount of cash. And so usually what happens when we're qualifying for the subject property, it's 2% above the mortgage rates. And so if a mortgage rate, for example, for your property is 5.5%, we're actually stress testing. We're using 7.5% on our lender formulas. So we're no longer using your 5.5% that we're actually getting. As a requirement from the government. So this is OSFI again. OSFI again is the regulator that oversees all lenders. They're the ones that have strapped this requirement on. The requirement and the guideline is called the B20 guidelines that came in a few years ago. And they actually control the federally regulated banks and credit unions. So there's a couple of credit unions that are included that as well, but some credit unions are provincially regulated, which means that they're not necessarily required to use the same guidelines as banks. Last item that can come up to help alleviate some of this is your net worth or self-employment income. So we have a few programs where we can use your net worth if you have a substantial amount of net worth and a low income. Sometimes we can use that to pad the borrowing capacity. The strongest one that we have, what they do is they qualify your income and then they add dollar for dollar what your liquid net worth is, as long as you have a certain amount. Or we have self-employed programs like a NIAT program or net income after taxes, where they look inside your business, they peek inside, understand what kind of extra income that you're making in the business, and then use that to help qualify as well. This can be super useful if you're deciding to take a low income from your business and leave a lot of the cash in the business. So these programs are really powerful for low income borrowers. Sorry, there we go. Complexity. Going back to the tiered structure and the holding corporations and as well trust corporations, these things can make things very challenging from a lending perspective. In a lot of cases, most residential lenders don't really like these types of financing. And as we start moving into these more complicated structures, we have to start looking at lenders that are more along the sides of commercial or small business financing. So personal finances, it's all about debt servicing, focus on cash flow properties. So again, because the GDS, TDS, as well as the DCR are all based off of expenses and income, you want to make sure that you're paying attention to your expenses, including debts, and cash flow as well, because the income is going to be important. One of the suggestions that we often suggest to clients if they're looking to increase their borrowing capacity is trying to take 30-year amortization where possible. What this does is reduces the mortgage payments, the required mortgage payments on your properties by increasing the amortization. So one way, if you're especially looking to pay your mortgages off quickly, but you're still also looking to take on more debt for other properties, one of the suggestions that I often tell people is, you take a longer amortization, but you go with a lender with a stronger prepayment privilege. And so some lenders can go all the way up to 20% of your original mortgage balance. And so what that means is on paper, you have the lowest mortgage payment possible, which increases your borrowing capacity, but you can maintain mortgage pay down by using the prepayment. So if you have, for example, a $400,000 mortgage, 20% prepayment is $80,000 per year, which is very aggressive pay down. And it's more aggressive than having a shorter amortization in most cases. Eliminating all other high interest debt, especially car loans. We see this all the time. I actually had a client today that I was talking to. It was a $9,000 vehicle loan, which was relatively high with $900 a month payment. And the borrowing capacity was basically just eaten up just from the vehicle loan. So by simply paying off a $9,000 vehicle, it actually got this client to be able to borrow a significantly larger amount of mortgage. The example we have is if you have a car loan of $25,000 with $550 a month in monthly payments, it's equivalent to borrowing $100,000 of mortgage. So it's definitely something to take a look at if you're looking to continue borrowing and buying more properties, to think about your vehicle loan or vehicle leases, as well as credit cards and lines of credit and everything. One piece or one comment I will make as well with that, if you have an operating corporation that's making payments for the vehicle loan, we can often take that out of the underwriting because it would be double counted inside the business. But not all lenders will allow us to do that, because in most cases, when people are getting vehicle loans and leases, they're not actually putting it on the credit bureau for the corporation. They're actually putting it on the personal credit bureau. So even though it's in the corporation, you're personally liable for it. And so we're not really supposed to use that for a lot of lenders, but some lenders will allow it. Getting a HELOC, as we mentioned earlier, as well as in the other video, should be step one. Getting a HELOC after you've bought a whole bunch of properties is typically a lot harder than getting a HELOC at the beginning. I would suggest taking a look at that video because there's a lot of tips and tricks that Kyle goes over as well. Following the game plan, as we talked about before, if you fail to plan, you plan to fail. If you're self-employed, this is really important. If you're self-employed, to talk to both an accountant and a mortgage broker annually before you do your taxes. You want to make sure everyone's on the same page with what the game plan is, how much income you should take versus how much you should leave in the business, or how much you should expense and lower your taxable income. Again, the accountant is going to try to lower your taxable income, and that's the KPI that they go after. The lenders want to see you have as much income as possible claimed so they can use that for debt servicing. Feeling good. I think this is because you bought a bunch of properties and then you've gotten declined. Here's what you're, sorry. There's a wall. So this has to do with the provide property wall. I apologize, by the way. Kyle made the presentation. I've only been trying to go off the fly here. The four most common 5+ property challenges that we see: low personal income, as we were talking about. Professional landlords and self-employed clients. Professional landlords usually don't have eligible income from a base income perspective, so it does become more challenging. Self-employed clients, again, with the tax accountant, they will reduce your taxable income in most cases, increasing your expenses or leaving the income in the business, which can make it challenging on the residential side to get financing. Portfolio cash flow. What is this? Oh, yes. So portfolio cash flow, this has to do with something I talked about really briefly at the beginning, is too many speculation holds or development plays. So this could be stuff in, for example, the lower mainland or GTA, where we're expecting higher appreciation or increases in property values. Typically, what we find from an asset class and characteristic is the higher the expected appreciation, the lower the cash flow or the lower the rental income. And what that can do is it can actually decrease the borrowing capacity by having lower income. So those types of properties can be difficult to scale with. So sometimes you'll want to have a portfolio with a mix. Maybe you want to buy a few cash flow properties to help circumvent the low cash flow on the appreciation property or something similar. Or maybe you want to siphon off different corporations for different types of asset classes to keep them off the portfolio as a whole. This can be especially important when you have things like lots or you're developing, because there's going to be no rental income or any sort of income on those two types of properties. So if there's mortgages on those, you're going to have a bunch of expenses with no income to help support it. Or even pre-sales. Like if you're buying pre-sales and you take the deposit from like a HELOC, for example, you'll be making payments on the HELOC for the duration that the deposit's taken out, but we don't have any rental income for the pre-sale until it's purchased. Number of properties. This has come up a few times in this presentation because it's super important. And one of the things I will point out is more recently, I have had some conversations with a B lender or an alternative lender who usually don't have maximum number of properties or doors. And it sounds like OSFI is actually holding the straps on alternative lenders as well and reducing the number of properties that they'll allow you to have as well. And what it seems like is that OSFI and the regulators are trying to make it so it becomes harder and harder to build a real estate empire with residential financing. It seems like what they want to happen is residential financing to be specifically for individuals to buy homes and maybe one or two or a couple of properties and not to build a portfolio. So what I'm expecting is over time, this does become more and more challenging. But currently, there are lenders that will allow multiple bigger properties and portfolios. But we do have to navigate those guidelines and just be aware for your game plan and timeline here. Liquidity. This is super important. The rule of thumb is you would like about $30,000 to $50,000 in cash per property as the target. This is something that the lenders like to see. But I will also mention that you probably should look at having that liquidity anyway as an investor. I do a lot of reading, and one of my favorite investors is Ray Dalio, and he does have a book on debt cycles. Fantastic book. I would strongly suggest reading it. And what he talks about is in the past, 3 of the biggest debt downfalls in history. And every single one had one really common theme is taking on too much debt, the cash flow balloon or the cash expense balloons. And then those countries didn't have enough liquidity to cover the balloon payments, and it causes a crash. And the same thing can happen with real estate. You do want to make sure you have enough liquidity to weather storms. I'm sure anyone who has a few properties here probably felt that at the very beginning of COVID, as people stopped paying rents for a period of time, or a lot of people did. And it became really hard if you didn't have liquidity to cover that. Solutions. There's always a way to get around the majority of these problems. You just have to be a little bit creative and potentially partner up with people as well, which we'll get into in this chat. Oops. Proper lender selection, first and foremost. Very key pieces, because there's a max number of properties total, max number of properties with that lender, and a max aggregate lending with them. So the amount of mortgage that lender will have. Again, these are largely around residential policies, by the way. The commercial lenders don't have these types of policies, and we will touch base a little bit later, specifically on commercial financing and where that fits in. So what we generally try to do is we try to plan out a portfolio with lenders that don't have more than, or don't allow more than 5 properties. So some lenders will have limitations that are even tighter. And we do want to try to use those closer to the beginning, even if they're at slightly higher rates, because then we can save and preserve the lenders that do more properties for later. So sometimes what we've done in the past with people's existing portfolios is we might restructure or refinance, move them to a different lender that would optimize their continued growth first, and then move forward with continuing to finance. There are expenses, and it does get a little bit pricier to do that. But by doing that, we can open the door for multiple extra properties in the future. In saying that too, a big step on sometimes increasing your portfolio is refinancing and pulling equity out or optimizing the existing portfolio, which can make a big difference. Once we do that, it keeps the doors open for multiple properties after. So now we'll get into commercial financing. We're going to talk about commercial financing as well as a bit of small business lending, because small business lending is very similar to commercial. Small business is a separate department that not all lenders have, but some lenders have. It's kind of a weird small piece that most people actually don't even know that it exists. But what they do slightly different than commercial is they have commercial guidelines mixed with residential guidelines, which can help the intermediate real estate investor quite a bit continue to scale. But for now, we're gonna stick with commercial and make sure that we understand the commercial side here. So typically commercial is when you're buying 5 or more unit rental properties or residential properties and mixed use, as well as retail, industrial, and often development, especially if you're going to be selling the development project. So the main piece is that they use a DCR or debt coverage ratio. And basically, again, what that is income divided by expenses typically needs to be above 1.1 or 1.2. So the example we have here is $125,000 a year income generating property would have a $50,000, like the example is having a $50,000 operating expense. The maximum mortgage payments per year is $50,000. So what actually happens in reality in reality is the loan to value or the amount of mortgage that you actually get is not determined by your strength or the property's equity. It's actually determined almost entirely by the income generation of the property and a few risk adjustments as well. And so things that we see is places like the Lower Mainland, if you're buying a 5-plex or larger, is the loan to value might actually be significantly lower than what you're expecting. So you'll sometimes hear mortgage brokers or bankers talk about how commercial can do as low as 25% down payment, when in reality for the greater Vancouver area, multifamily property might be closer to 30 or 40% loan to value. So you might need 60, 70% down payment for properties, depending on their circumstance. On the flip side, if you go out to the Maritimes like New Brunswick, the cash flow is extremely high, and you might be able to get a higher leverage or a higher mortgage based off of the income. The one comment there as well is we are seeing the new CMHC MLI Select product, which has helped quite a bit with that. This product is a special insured mortgage for commercial products that allows you to go up to 50-year amortization and has significantly lower rates than other commercial, conventional commercial mortgages. And so that's been helping quite a bit with the loan to value. The biggest downside right now with the CMHC product is that the timelines for it are extremely long. And so you usually need a different plan or a different strategy when we're planning to use that type of product. So that brings us to joint ventures. Joint ventures are very important when you're scaling. In most cases, as people get to the intermediary and advanced stages of their portfolio, they will have some sort of partnership at some point. Joint venture partners are very challenging on the residential side, but they're very common on the commercial and often the small business side as well. And there's 4 types of partners, 4 classifications of partners that you can have in a joint venture partnership. Sometimes a person will cover more than one. So it doesn't have to be 4 people, but you want to look for 4 characteristics. And those are the cash partner, the managing partner, the deal finder, and the qualifying partner. In a lot of cases, the cash and qualifying partner could be the same person. The managing partner and the deal finder are often the same person as well. Anyone can do it. So Kyle has a story. I think he was 21 where he did his first real estate deal, and it was a joint venture partnership where he didn't bring any of the capital into the deal, but he was the managing partner and they both qualified for the mortgage. He was able to raise the capital and buy the property with no cash in the deal. many steps that are very crucial. Getting a JV agreement done is, in my opinion, probably the most important. Relationships, as good as they are, can potentially break down, and having an agreement with exit plans and rules and everything can make a huge difference. There's different liabilities and laws that are in place for joint venture agreements. So I would suggest talking to a real estate specific lawyer about these. Real estate does have its own nuances compared to other business types, but having a JV agreement done is absolutely crucial in these cases. Qualifying partner must also have the down payment. So this is especially important on the residential side. Lenders typically do not want you to have capital coming from a miscellaneous person that's not also on the real estate title and mortgage title. So they do want the people who are qualifying to have the down payment, and the people that have the down payment to also be qualifying for the mortgage. Networking is key. Very, very, very important thing in real estate. There's a lot of conferences and communities in the real estate industry, as well as just networking outside of the real estate, because that's where a lot of capital exists. There are quite a few people that have cash and are looking for really good investments outside of the classic equities and bond market. So networking is really important and crucial if you're looking to scale up a portfolio. And last, find a partner with different strengths. So finding somebody that has the exact same strengths as you sounds great, because then you have a buddy, but at the same time, they're not filling the gaps that you may have. So finding someone that has strengths where you don't have strengths, or somebody that can take on things that maybe you're not quite as good at, can make a really great partnership. Really important is remembering that your game plan varies person to person. Everyone has different goals, different current situations, different areas. Even like if you're in Edmonton, for example, your game plan might be significantly different than if you're in Vancouver. It might be different if you're in New Brunswick. So everyone's game plan is quite different, and there's no one size fits all for anyone. Also, if you're looking for cash flow versus appreciation type plays, or you're looking to get into development or BRRRR or short-term rentals, all of these game plans are significantly different. So it is something to pay attention to. But getting 5+ properties makes it even more nuanced. Easy button. I'm sure he was talking about how it's easy. It's probably a joke or something, because it's not quite easy. But if you guys would like to book a consultation, that's pretty much everything that I have to talk about today in the presentation. So I added a QR code. It goes directly to consultation. It's a free half-hour booking. No obligation. So we're not going to require you to get a mortgage with us or anything by having a consultation. But we are happy to have a conversation and try to map out what you're looking to do with your real estate portfolio. We also have cash flow analysis tool. We have a whole bunch of tools actually that we built. Really interesting one is our commercial analysis tool. So if you're looking to get into commercial financing, it can be helpful to get a high level idea of how much loan that you can get. So not only it helps with the cash flow of the property, but also we'll understand your loan to value and down payment requirements. But we have both a residential as well as a commercial one. This is the commercial one that you're looking at right now. Turn knowledge into action. We have a bunch of content on our website as well. Right now, we are kind of redoing our website and adding a bunch of blog posts. I don't know the ETA of that coming out, but there will be a lot of written material on a whole bunch of real estate investing stuff. So stay tuned, and we'll have that out ASAP for you guys. We also have webinars, 7 p.m. first Wednesday of the month, every month. Spreadsheets, as I was mentioning, and FAQs that are on the website. Kyle's wrote a book, Rockstar Real Estate Investing. I think actually probably quite a few of you in the attendee list have probably read it already. It's a really great, easy read where he goes over some of his past real estate investments. It's really good for creative thinking, a lot of really interesting things that aren't necessarily publicly discussed in a lot of blog posts. So it is a good read. If you'd like a copy, give me a shout. I'm happy to send one over. You can shoot me an email and just let me know your address, and we'll send out a physical copy for you. And that is my presentation. I will take questions. I'm going to be honest, I don't really know how to turn on other people speaking. So I think what we'll do is either use the Q&A or the chat. So if you guys have any questions, drop it in the chat and we'll go over them. I think I saw one earlier. You're asking about Square One insurance for residential properties. I'll probably message you separately. We did have an insurance company that Kyle knows of. I've personally never heard of Square One, so I'm not entirely sure. Let me throw the email in here. Yeah, so if you'd like a book, just shoot me an email. Add the address in that you'd like the email or the book sent over to, and I'll fire it over for you guys. Okay, and then Q&A. Okay, so I have a question. You mentioned a holdco is more optimal for taxation. However, passive income in a corp is now taxed at 50%. Can you elaborate on how rental income in a corp would be more advantageous for taxation? So it's not so much that it's necessarily more tax advantageous on the small scale in the holdco. This is actually a really good question. As you start building a portfolio, one of the interesting things that can be done is you can also open a property management corporation under certain circumstances. So it is a tax question, and you'll have to get some of the details specifically from a tax accountant. But the rough rule of hand is if you can have 5 or more employees, or if you're managing other people's property as well, I think you can declare it as an operating corporation. And what you can do with that is you can actually fee your holdco into the operating corporation to bring now the rental income into the operating corporation to move it into a lower tax bracket corporation. So it does get a little bit more complicated, but yes, the holdco taxes are a lot higher. So keeping the real estate and rental income in the holdco is not necessarily a tax advantage, but it will have an advantage from a lending perspective. Hopefully that helped answer that. I have a question. Which lender is friendly with 5+ properties? So with 5+ properties, typically it's commercial financing. Most commercial lenders will do 5+ properties. There is 1 or 2 residential lenders that can sometimes do 5+, but they're very hard to qualify. So from our experience, they usually don't often get used. But even the CMHC product, the MLI Select, can technically go down to 5+, but there's only a few lenders that will do that small of a mortgage. So there's another part of the balancing act is with commercial lenders, they do down to 5 units, but sometimes some of the lenders will have a minimum amount of mortgage that they'll qualify because the commercial side is a lot more work on their part. So they might have a minimum amount of debt. Can you explain bridge financing and when to use it? Yeah, so this is a really good one too. So bridge financing is a really interesting type of product. Basically what it is when you have a portfolio of a bunch of properties, you can put a mortgage kind of strapping over multiple properties. And so instead of getting a mortgage per property, you have one mortgage that takes over the entire thing. Some of the nuance with it is pretty much no residential lender really does bridge financing. It's usually either private lenders or commercial lenders. So what that means is usually at higher rates and potentially lower amortizations to what you're used to on the residential side. And that can mean 1 to 2 things or both things is increased monthly payments on the mortgage, which can reduce your cash flow. And by reducing the cash flow, it can actually reduce the loan to value. So what we've seen quite a bit is a lower loan to value on a bridge financing. And they might not be able to do the bridge financing because the loan to value on the bridge might be lower than the existing mortgages on that property. Or the client may want to pull more equity out and the bridge financing equals what the current mortgages are. So it can get a little bit tricky because of the DCR debt coverage ratio. At what point might you consider rolling a number of res properties into commercial operation? And what effect does that have on future mortgages? That's a complex question. That's a really good one, actually. So a big piece of that question is actually very specific province to province as well because of property transfer tax or land transfer tax. Rolling it in is something that could be really expensive, but it also could open up your borrowing capacity depending on how it's done. So for example, if it's in the corporation and you're using commercial loans, it's now not applicable to residential mortgage applications. And so one of the dual uses of moving into a corporation and the bridge financing is you can potentially strap the bridge financing on the residential properties and replace the mortgages And it basically takes the whole thing off of mortgage or residential mortgage applications, which would potentially restart the number of properties for your portfolio. So it can actually be really helpful, especially with that bridge financing. Small nuances as well that'll have more to do with like the tax effect and how those properties come in from an income perspective, because now you're in a corporation, so you might be claiming income on your T1s or something like that. So it does affect the debt servicing as well, because those properties are no longer on your residential portfolio. Let's see here. Have the current interest rates surpassed the stress test rates from a few years ago? Yes, they have by quite a bit. So in the beginning of the pandemic, we were seeing rates sub 2%. There was one lender doing like, I think sub 1%, which was insane. It's basically free money, which was wild. The stress test was 5.25% because there is a floor on the stress test. And so 5.25% is the lowest that we were seeing people stress tested on federally regulated mortgages. Right now, with rates being where they are, we're seeing a lot of rates between the 5.5% and 6% range for most fixed products, in a lot of cases for investors. And we're stress testing 2% above that. And so 2% above 6%, for example, is 8%. And so we're actually stress testing at 8% right now for new applications for a lot of clients. There are a few lenders that are a bit lower, but we are about that. There's quite a few lenders also higher than 6%, depending on the needs. So if you're looking for someone or for a lender that has really, really strong policies, sometimes they might have a higher rate. So this is also probably something that maybe I should have added earlier is, as a real estate investor that's scaling up, you are doing a balance between access to capital and cost of capital. So sometimes to gain access, you do have to charge, or you do have to expect to pay a little bit of a premium on rates and fees. Unfortunately, the higher rates also get stress tested. So it's a great question. Looks like that is all of the questions. I will give you guys a minute in case anyone has any other questions. Otherwise, I will end the webinar. Again, this will be posted on YouTube if you would like to re-review and take more notes. And if you need a book or have any questions, shoot me an email. Just dropping my email in here one more time in case you guys need it. But our website and everything is on the screen here as well if you need anything. But thank you guys so much for coming out. We really appreciate it. And hopefully you guys learned some stuff and this was valuable to everyone.